James Shugg is senior economist at Westpac Banking. He's here in studio with us. So we saw better than expected numbers here. Should we remain hopeful that we're going to see us continue to build in months ahead?
I'm not too hopeful, no. I mean, we've actually already started to see some disappointing numbers come out of the housing market from more up-to-date indicators. I'm talking about, for example, the permits figures that we had earlier this week. Now, existing home sales are telling you what was happening in the housing market a couple of months ago, and it's clear that bargain hunters have been out there snapping up houses at 50% less than they were sold for 2 years ago, and of course the first home buyer tax credit's probably helping in there too. But those sorts of drivers of the housing market aren't going to be sustainable over the longer term. And in fact, it's interesting. We've got an expectation that dwelling investment in the third quarter, which will be released as part of the GDP numbers next week, that'll actually be another negative. Construction underway in the US housing market is actually still declining, even with the recent upswing in starts and permits.
Yeah,
so
we saw starts rise less than expected in September. So that's part of that story you're talking about.
It's starting to, but starts have been rising for 6 months or so. But housing activity, that is construction actually underway, is still falling. So I think today's existing home sales numbers really kind of exaggerate the sort of optimism in the housing market that really isn't justified.
And you're seeing the optimism about that reflected in the market reaction right now, with gains after we release these headlines. But you're saying November 30th, when we see this home buyer credit expire, we might see this, just like with cash for clunkers, for example?
It's a temporary stimulus. It brings forward activity from the future. Anyone who's considering the merest possibility of maybe contemplating buying their first house has probably done it now. And so our sense is that heading into 2010, we're going to see a resumption of softness in the US housing market. And unemployment at 10%, that's not helpful for the housing market either.
Right. Well, so many people say you can't just look at sales numbers. You also have to look at the price that these homes are going for. We did see the median price fall, but at the slowest pace of the year. Does that say anything different to you?
Not really. That's consistent with what we've seen in other price measures. That is that there is some bottoming out in housing prices now taking place. Although even on some of those measures, and I'm referring to the government house price figures that came out earlier this week, there's some evidence too also of a bit of renewed slippage coming through there. So I wouldn't read too much into the price numbers. At least they aren't as falling as dramatically as they were, six months ago. But that's what you'd expect to see happen too, with bargain hunters out there snapping up really cheap houses. That is going to put a bit of support under prices temporarily. But there is still a big glut of houses for sale in the US, and that's going to continue to weigh down on price action.
And a lot of that at the higher end of the market, a lot of that pressure there. What is that story? Because that's obviously not necessarily the same person who's going to use the home buyer credit. So is that telling us? Well, is that almost more indicative?
Actually, I got a friend who put his house in Fire Island for sale recently. 2 weeks after he got the asking price. So there are some pockets of strength in that sort of leisure and upper end market.
We were hearing that about the Hamptons. The Hamptons home sales surged 32% in the third quarter. We had that report on Bloomberg just yesterday.
But how much did it tank during the depths of the financial crisis, when anyone who lost their job in the financial sector was looking to sell the house? Those sorts of markets were suffering. They are now turning around. They are now starting to bounce from a very, very low base. But again, a bounce from a low base doesn't necessarily mean you've got a sustainable recovery starting to come through. So that's why we're still a bit sceptical about the US housing story.
So, but does the housing story make you question the broader economy, another leg down, or?
Not the housing story per se, but there are other factors currently driving some good news on the US economy, such as inventory rebuild, which is about to get underway. We thought it would be a driver of the third quarter. It now looks like it would be more a driver of the fourth and the first quarters. But heading into about the middle of 2010, our expectation is we could actually see US growth, economic growth, bottom line GDP, actually turn a little bit negative again. So not the W that some people are talking about, but a real levelling off in growth next year as stimulus unwinds.
Okay, well, we'll follow up with you then to see if that forecast rings true. Thank you so much, James Shugg of Westpac Banking.